Do you think that gold can be considered a viable investment alternative to paper currencies?
Yeah, we're not enthused about gold.
Warren Buffett, the 94-year-old chairman of Berkshire Hathaway and one of the world's most successful investors, has maintained a consistent stance throughout his career. Gold is not a worthwhile investment. In his annual shareholder letters and numerous interviews, Buffett has emphasized that assets should create value, not just store it. Unlike businesses, farms, or real estate, gold doesn't generate ongoing returns or produce anything tangible. Gold gets dug out of the ground, melted down, then buried again and guarded, Buffett once remarked. It has no utility. Anyone watching from Mars would be scratching their head. Historical performance data supports Buffett's position. Since he took control of Berkshire Hathaway in 1965, gold has increased in value approximately 46 times. While this might seem impressive, during the same period, the S&P 500 with dividends reinvested has returned roughly 280 times the initial investment. Berkshire Hathaway shares have multiplied original investments by over 30,000 times. Market analysts point out that Buffett's skepticism extends beyond performance comparisons. The Oracle of Omaha has expressed concern about the ongoing costs associated with owning physical gold, including storage and insurance expenses. These are drag factors that productive assets don't suffer from, said financial commentator James Reeves. Companies cover their own overhead through the products and services they sell. Buffett's position stands in stark contrast to many investment advisors who recommend gold as a hedge against inflation and economic uncertainty. While gold has occasionally performed well during economic downturns, its effectiveness as an inflation hedge has been inconsistent over longer time frames. Instead, Buffett prefers businesses with strong competitive advantages, what he calls economic moats, that can raise prices during inflationary periods without losing customers. His long-term holdings in companies like Coca-Cola, American Express, and Apple demonstrate this strategy. In a recent interview, Buffett elaborated, "If you own a well-diversified group of equities, you own pieces of productive businesses that, as a group, are bound to do well." Financial planners suggest that while Buffett's track record deserves serious consideration, individual investors should evaluate their own goals and risk tolerance when deciding whether gold belongs in their portfolios. For those following Buffett's approach, the message remains clear. Seek investments that create value through products, services, and innovation, rather than those that merely store value. The magic of compounding works best with productive assets, notes investment strategist Sarah Chen. When businesses reinvest their earnings to grow and become more efficient, they can create returns that precious metals simply cannot match. As Buffett continues to guide Berkshire Hathaway with this philosophy, his gold-free portfolio serves as a powerful testament to the long-term success of investing in productive enterprises rather than shiny, non-productive metals.